So this 4-hour time frame is really important because if used correctly, you can see the entire move from the previous trading week, and this will help you determine where price is going or where the high and low for the upcoming trading week will be set. Now remember guys, your only job as a Forex trader is to locate the high or the low of the time frame that you're trading. Since we're going to be looking at the 4-hour time frame for this video, then your job is to locate either the high or the low of the week, because the 4-hour time frame from line to line shows what price has done for the week. If you look from this line to that line, you will see how price moved the entire last week. This was last week's move. So your job as a Forex trader is to locate either the high and low of the week and trade from either one of those spots. Your best trades, your most optimum trades, right? Your highest probability trades is to trade the high or the low of the time frame that you're trading. Understand that. Let me say that again. Your best trades, your highest probability trades will either come at the high or the low of the time frame that you're trading. Now, in this video, we're going to take a look at the entire top-down approach. We're going to start from the monthly, the weekly, the daily, and then I'm going to show you guys how I use the 4-hour time frame to enter trades. It's going to really show and give you a good understanding of why the 4-hour time frame is so important. If the 4-hour time frame is the time frame that you're going to incorporate in your trading as in the new level strategy. Alrighty guys, let's take a look at the 4-hour time frame. So this is how you would approach the market every single week to really dissect and figure out, not only which direction the market is going, but when to take your trades on a weekly basis if you're swing trading this market. So here's the top-down approach. Here's the exercise that I do that properly shows you how to trade the 4-hour charts. And once we go through this exercise, you will understand why the 4-hour time frame is so important. Alrighty, so let's start off on the monthly time frame, and we're looking at New Zealand Swiss franc. So from the larger time frames, from the monthly as well as the weekly time frame, what I'm basically looking for is to gather direction of the overall trend of the market and to kind of mark out where the trend could reverse or the trend could change. So here's what I mean. So I know this is a down market, right? So I'm just going to go ahead and mark a trend line right here. Right here. It's the overall down market. Or you don't want to go too far out. So actually the trend is right here. Right? So that's what we're looking at so far in this market on the New Zealand Swiss franc. Alright, one touch here, there's another touch here. We're projecting or predicting another touch will come up here and start this move down if this move hasn't started already. So again, we're not looking to trade this, we're just trying to get a feel for the overall direction, and we know that the overall direction is down on this market. Okay, now let's go to the weekly. Okay, alright. So you see our trend line is still in place. The weekly tells us a little bit more information, but still, we're only looking to get a direction of the overall trend. Okay, but we can also see some levels here, where some support levels as well. So what I see here, I see a nice level of support. Make that a little bit thicker, right? So that's support. Resistance, right? And that's all I want to do. That's all I want to just, mark out. We don't want to really be looking to trade on these larger time frames because these are extended. These are really big moves. So it may not be in the immediate direction that the market is going now. But okay, so that's my weekly. I marked off my levels. All right, so let's go to the daily. All right, so you see my trend line. Let's compress this a little bit. You see my trend, my weekly, my monthly trend line right here. Now we can dig in a little bit more. All right, So now I know I also got a trend line right here. And I go far out, but you don't really have to go that far out. You don't really have to go that far out setting the trend. So, okay, so the downtrend is still in play, right? Still in play right there, right? My resistance level is right here. My major support level from the last move to the downside is right here. Support, resistance, resistance. All right. So I may be able to get a move. I'm already seeing where I may be able to get a move at least back down to this level right here. All right. But now, so this is where we would get the signal on the daily time frame. But we would always take our trades on the 4-hour time frame. So here's when it comes in, why the 4-hour time frame is so important. So let's go to our 4-hour. So understanding which way the market is going and actually knowing how to trade the market is two completely different things, right? Anyone can see that the market is in an overall downtrend when you're looking at it from the monthly, weekly, and the daily. But when you go down to the smaller time frame, we all know that the market doesn't just move straight down. It's not going to just move straight down. You know, the market has retracements or pullbacks or whatever you want to call them. So even though you're in an overall downtrend, you look right here, the market for a week and a half moved all the way up. Moved all the way up. I say a week and a half because, again, from this line to this line on the 4-hour time frame is 1 week. So it moved all the way up. But now it's getting back in line with the dominant trend, which is to the downside. So this line to this line represents last week, right? This is the current week that we're in right here. This is the move. So how would you trade this week's price action or this week's or the pair for this week? Here's what you would do. So you only want to trade in the dominant direction of the trend, right? You don't really want to take these buy trades unless you're a very experienced trader, because then you counter trend trading, right? You can make a lot of money counter trend trading, but you want to be very experienced. And just to give you the heads up, you want to counter trend trade off major levels of support and resistance. Okay. The reason why is because you don't know when these trades are going to turn around and get back in line with the dominant trend. All right. Sidebar. But back to what we were saying on the 4-hour time frame. The reason the 4-hour time frame is so important is because if we look right here where the week started, and we know we want to trade to the downside, which is the overall trend. What you essentially want to do is you want the week to print the high of the week. You want the week to go ahead and make a high for that week, right? Because remember, your only job as a trader is to trade off the high or the low of the week, depending on which direction you're trading. If you're looking for buys, your only job as the trader is to locate the low of that week and then buy it up. We don't trade the in-between stuff. Well, you can trade it, but you have to be an experienced trader to trade these things. But as a new trader, right, you only want to trade off the high and the low of the week. If you're swing trading, depending on which direction the market is currently going, right? So if we know the high of last week was here, because remember, line to line equals 1 week. This is last week. This is our current trading week, right? We know that we're still in a downtrend until the high of last week is broken. Think about that for a second. If the high of last week is broken, which is the 4-hour time frame, it shows the week. So when I'm saying a week, guys, I'm talking about the 4-hour time frame, right? Because the 4-hour time frame shows you what the price is doing for that trading week. Okay, the weekly charts shows you what price is doing for the year. Okay, but the 4-hour time frame shows you what it's doing for the week. So when I'm mentioning the week, I'm not talking about the weekly time frame. I'm talking about the 4-hour time frame. So we know that until price really breaks this level of the previous week, meaning until price trades higher, we know we're in an overall down. We're still in a downtrend. So for this week, the only thing we would be looking for on the 4-hour time frame, since we know we want to trade to the downside, the only thing we would need to look for is where is the weekly high? On the 4-hour time frame, where did price print the high of the week? Where is the high of the week? And then you can use certain things like candlestick structure. You could have certain entry triggers. You can use your momentum oscillators. You could use your moving averages. There's a lot of different entry triggers that people use. You decide which is best for you. But before you select the entry trigger, you have to understand what the charts are doing. So on the 4-hour time frame, that's why the 4-hour time frame is so important. You want to look for the high and the low of that week. Remember, the 4-hour time frame shows the price action within the week. So depending on if you're buying or selling, you want to look for the high or the low of that week. That is why the 4-hour time frame is so important, because it is a time frame that I commonly trade on. Trading a new level strategy, you can get great entries on the 4-hour time frame, and you can ride those time frames for 2 to 3 days. 2 to 3 days, because the market, it tends to reverse after 2 to 3 days of one extended move, right? This is the exception. This is definitely the exception. Although this could be like 3.5 days. This is definitely the exception. But the market tends to reverse. It's called midweek reversal after a few days of an extended price move. You usually have 3 pushes. So this would be one push, retracement. This would be the second push. This would be a third push. I would look for a reversal, either coming here off this level here, or a reversal from this extended level to the downside. Either or, but again, this is why the 4-hour time frame is so important, because it shows you, it gives you a great time frame to trade. If you're trading for that week, you know that you're looking for the high or the low of the week that you're trading, depending on the direction you're trading. If you're buying, you're looking for the low, and it makes everything a little bit clearer for you to understand what's going on in the market. So that's why the 4-hour time frame is so important. Alrighty, guys, Forex King. So the daily time frame, guys, hands down, is the most consistent time frame to trade in the Forex market. In fact, if you want a very high win rate or to add more profits to your trading, then you most definitely want to make trading on the daily time frame something that you do on a regular basis. What makes a daily time frame so reliable is that each candle shows the entire daily move, but it's all in one candle. This takes all the guesswork out of trying to figure out what happened in the market for the previous day, and it also gives you a pretty good indication of where the market may be going on the next trading day. Now, when trading off the daily time frame, you basically only have to check your charts one time per day. That is at the close and the opening of the new trading day. You do this just to make adjustments to your positions and to look for new trading opportunities that may have set up on the current trading day. Now, if you take a simple trading strategy, such as one that says sell when price is trading below a 200 period moving average, and then buy when price is trading above a 200 period moving average, if you combine that with the daily time frame, you will be trading a profitable strategy. This simply shows the consistency of trading on the daily time frame. Now, I'm going to show you guys a few examples on the charts to show how easy it is to trade right off the daily charts. So what I'm going to do right now, I'm going to show you guys how powerful the daily chart can be. And I'm going to give you guys a real simple trading strategy that you can use where you can profit from trading the daily time frame. And this strategy right here, guys, is designed for those that, probably just want to look at the charts one time per day, hold their positions for, a few days to a few weeks, and be highly profitable in the Forex market. So what I have on the charts, I have a 200 period moving average right here. I have a simple support and resistance. These are round number support and resistance. You can plot your own support and resistance on the chart. It really doesn't matter. And then I have the Heiken Ashi candles so you can easily see the reversals or the trend in the market. And here's a simple trading strategy. The only thing that you're looking to do with this strategy, guys, is trade when price is below the 200 period moving average. You want to be looking for sales based on the reversals in the market. And when price is trading above the 200 period moving average, you want to be looking for buys based on the reversals of the market. So here's the strategy. So you would simply just, let's go back, right? So this strategy can be traded really easy. So basically what you have is price going up, right? So we don't want to take this buy right here, because remember, we're looking for sales because price is trading below the 200 period moving average. So once, using the Heikin Ashi candles, once you get this reversal candle right here, this momentum candle right here, you want to go ahead and go short. You want to go ahead and sell, right? You want to stick your stop loss behind the swing high of the previous consolidation period. So price consolidates when you get this sideways action right here, this sideways trading action right here. This is a consolidation. So what you can do, you can just simply mark off where price is consolidating, right? So you see price went up. These candles right here, they basically traded in the same area. That's called consolidation, right? So when price breaks out of this consolidation, is usually about right here. When price breaks out of the consolidation, you want to go ahead and put in a sell order right here, and you want to put your stop loss back here, and then you just want to ride the market on down for some pips. All right. Once price starts to reverse right here, you want to actually get out. I mean, you can actually throw an oscillator. You can actually throw like a stochastic or something in addition to that on the chart, so you can actually see where price is reversing. I always like to use 5, 3, and 2 as the slowing part of my oscillator. You can just leave everything else as it comes, close that out. So right here, so in conjunction with combining the price, this sideways action right here, boom, when price comes out of this right here, this momentum, and then you can use the oscillator when price crosses below the 80 level, or when price crosses above the 20 level, you know it's time to trade. So when price goes below, you want to go short about right here, and you want to ride this market on down. This is 80 pips stop loss. You want to ride it on down. You know, there go your 1-to-1, your 80 pips, and you want to take it as far as you can until your oscillator turns back over, starts to turn over right here. That indicates, you know, you want to go ahead and get out of this position. Then you wait for the market to trade back up and give you the same setup right here. Gives you pretty much the same setup right here. You want to go short, stop loss goes back here, ride the market on down. Remember, it's all about trading. It's all about trading below the 200 period moving average. So you're looking for shorts. You're looking for shorts. Now, then the reversal, the opposite of that trading strategy comes into play when price crosses above the 200 period moving average. Then you want to go ahead and look for buys. You want to look for buys. So this is a real simple trading strategy that can be easily traded on the daily time frame. The reason why this strategy works so well on the daily time frame, because the daily time frame cuts out all of the noise being traded in the market. So if you take this candle right here, let me show you guys. If you take this candle right here, I'm going to place my line on this candle, When you place your line on the candle, when you go back to on the 1 hour time frame, the line is going to be at the beginning of the day. Remember, this is a daily time frame, so each candle represents one day. So when I go down to the 1 hour, let me show you guys. When I drop down to the 1 hour time frame, wherever that line was placed on the daily is going to start me at the beginning of that day, right? So here is that actual day right here. This is that full candle right here. This wasn't the best example, but on the daily time frame, you just get one big red bar. But as you can see right here, we had a pullback on the 1 hour time frame. We had a pullback. Let me find a better example for you guys to try to show you guys what I want to kind of convey. Let me try to find example. I know I could find it if I was using regular Japanese candlesticks, but I'm using the Heikin-Ashi candles. They usually only show the trend in the market. That's why I love trading with these candles. But here we go right here. Here we go right here. So if we look at this candle right here on the daily time frame, this is going to be one small red candle, right? So let's go back to the daily. See, this is a small red candle, right? How did I know this was a small red candle? So look at this candle, guys. Price came out, went up, but it closed lower than it came out, than it opened. It closed lower than the open. That's why the candle is red. So let's take a look at it on the 1 hour time frame. Show you why the daily time frame is so good and nice to trade off, because you don't get all of that noise. You only see what actually the beginning and the end, right? So as you can see, price came out, it went up, and then it closed. Price closed for that day lower than it opened. That's why that candle is red. But you see all the noise. This is much more difficult to trade than that small red candle, because you would have been going short, because the previous day's candle was a bearish candle as well. So just to show you guys how easy it is to trade using the daily time frame, hands down, if you trade off the daily charts, it's the most consistent time frame to be trading off of. The con to trading off the daily time frame is that you don't get setups. You don't get a lot of setups. You don't get readily setups every single day. A lot of traders like to be in the market every single day taking trades, but on a daily time frame you don't get as many setups daily, because you have to wait, because the moves take much longer, or the setups takes much longer to develop. So you don't get a lot of trades trading off the daily. That is one drawback from trading the daily. But if you're patient and you're willing to wait on the trade setups, you can be more profitable, simply meaning you have a higher win rate, as well as you'll be able to pull more pips out of the market. I pull hundreds of pips out of the market every week simply trading on the daily time frame. So guys, so all time frames are important. The daily, in my opinion, is probably the best time frame to trade off. Forex King. If you've learned something from this video, please like, share, subscribe to the YouTube channel. All right, guys, have a good day. Alrighty, so let's go ahead and take a look at the weekly time frame and discuss why the weekly time frame is so important for all traders. The weekly time frame, first and foremost, when you look at each candlestick on the weekly time frame, each candlestick represents 1 week of price data, or whatever price did for that week, or price action, however you want to say it. But each candlestick, each individual candlestick right here, represents 1 week of price data. So this is everything that took place with price for last week, for the entire week of last week, because today is Sunday. The market hasn't opened yet, but based on last week, this is everything that took place in terms of price for last week. It's all in this one candle right here. So this is the week before last, so on and so forth, right? But the weekly time frame has more. It shows a lot more than just what price has done, either for the current week that you're in or the previous week. The weekly time frame shows you what price is going, or it shows you at least where price has come from for the weeks preceding the week that you're in. So let me back up and say this. If you're using MT4, right, and you go ahead and you place the session break lines on your platform, you would click properties, you will go right here to where it says common, and then you will make sure that this box is checked right here, this show period separators. You will make sure this period separator box is checked, and once it's checked, you're going to get this line right here. This line is going to appear on your charts. Now on the weekly time frame, from this line to this line represents a full year of price data. So you should have 52 weeks. There's 52 candles from this line to this line. So this is all of 2019 right here, right? This right here, this session from this line to this line was all of 2018. Okay. So as you know, if you really look at the chart, the weekly tells you a lot more information than just what this one candle did last week. Okay. For instance, if you take a look at, if you go back to 2018, let's just start right here, and you see price bounce right off this level right here of support, of resistance, right? So price came all the way down, right? Came down to this level of support to begin 2019, right? Price retraced a little bit, came back, went through the level, came down, retraced, and then went and touched this level right here. So it came from this major level of 2 years to this level right here of 1 year. And if you look at it right here, you can draw a complete trend line right here, showing the way that price traded, right? Now, what happened after that? Well, in 2020, price bounced off this level, came up, it retraced back to the breach level, which the level of, once it broke this level right here, of resistance, it came back and it retested this level, right? Well, the level's a little bit higher, but it retested this level right here of resistance, turned into support right here. And now it's bouncing off this level. You see it? So now that it's bouncing off this level, we can assume that price wants to go higher, right? It may retest this level again. After it breaks through this level right here of resistance turns into support, and there's a good chance that price may bounce higher. Continue up, back to retest this level right here of resistance, right? So here's why I say that. Simply because no matter what time frame you're on, price moves pretty much the same way. And price has a tendency to bounce, retrace. Support always turns into resistance. Resistance always turns into support. Well, not always, but a lot of the time it turns into support, and resistance vice versa. Price often comes back, retests the level to continue in the ways of the dominant trend. Okay. The thing about the weekly time frame is that the weekly time frame engulfs or encapsulates so much in its candles that these trends on the weekly are a lot stronger than the trends on the daily. They're a lot stronger than the trends on the 4 hour or the 1 hour or the 30-minute, 15-minute time frame, because there are their weekly movements in the market, their weekly trends, and they encompass so much of the price, of what's going on with the price, where the market makers would like to take the market. It is encompassed so much in the weekly candles. So I say that just to say the trends on the weekly time frame are a lot stronger than the trends on the lower time frames. All right. So how do we use the weekly time frame to trade if you are a position trader? Well, position traders, they hold trades for months, for weeks, months, even years. So clearly you can see, if you're a position trader, how you would use this. Well, what if you're a swing trader? Well, if you're a swing trader, which means you can hold a position for a few days up until a few weeks, you could always make sure that you're taking trades in line with the dominant trend. If you're a swing trader. So if you know, starting on the weekly, doing your top down approach, that the weekly candle last week was the bias was to the upside, well, you have a good idea that at least to begin the week, or at least after it breaks a level of support and resistance, you have a high probability that the trend will continue, or the bias or the direction of the trend will still continue, because these candles, these weekly time frame candles, are so powerful, right? There's a good chance that whichever way price is moving, it's going to continue that way. All right. So how do you use the weekly time frame if you are a day trader? Well,
same concept as if you were a swing trader. If I'm a day trader, right, and I have a bias that price wants to go up, well, I'm only looking for my trades throughout the day, or when I put it like this, when I analyze my pairs that I'm going to be trading, right, I want to make sure that to give myself the best opportunity for high probability setups, I want to just make sure I want to be taking the trades that's in the direction of the weekly trend, Simply meaning, if you're trading day by day, then price doesn't just go in one direction. So if the weekly time frame, if the trend is up during the course of the week, you may have a couple days of pullback. Well, if you have a couple days of pullback, you probably want to stay out of those trades until price reverses and falls back in line with the weekly trend, right? This will just make your trading or make your trade setups more high probability, to the point where once you take a trade, there's a better chance that you will have a successful trade, and you would avoid any serious or major drawdown, because keep in mind, you're trading in the overall direction of the weekly trend. As a matter of fact, before you take a trade, you should already have confirmation that price wants to go, or price is getting back in line with the direction of the weekly trend, right? So in short, guys, you can use the weekly time frame to trade any trading style, whether you're a position trader, a swing trader, or a day trader. The weekly time frame is really helpful. It's good that you understand what the weekly time frame represents. Let's not just look at the weekly time frame candles as saying that, the candle represents a week of price data. We know that's kind of like the obvious, but look back to the chart. Look back on the chart so you can get a direction of where price has been and where price wants to go. Okay? And by looking at the weekly time frame, you can get a really good indication about where price wants to go. Doesn't mean it's time to trade it yet, but you have patience, good money management, most importantly, good patience. You can wait until price lines up in the direction of the overall trend, which is the weekly trend, and trade in that direction. Just give yourself better high probability for trading. So, hey guys, if you've learned anything in this video, please like, then share the video, and also subscribe to my YouTube channel, Forex King YouTube channel. I really would appreciate it. Thank you guys. Have a good day.